Today's topic is how to trade options in a bear market, how to trade profitably when the markets are down, and what to actually do when you are in this type of situation where if you look at the S&P 500 futures chart, it is on a downward trend, probably 6 to 7, 8% lower from its highs of 6,166 points. It's currently trading at 56.28 right now. So what do you do? What do you actually do? I mean, this is a great opportunity to sell something, sell a put spread. My go-to strategy, my favorite one in these markets, in these volatile markets, is to sell a put spread. So let's cover that here. How to profitably trade in bear markets when the market is actually down. So what would I do here? I mean, on the ES side, yes, it's up 100 points today, but overall, if you look at the, if you look at the direction here, it's been up and down, but mostly there's one direction which is down. Looks like it's trying to find its bottom here at 5,500. 5,500 is the bottom line, which is a support level for me in this bear market, but it could actually go lower from here. However, if I do have to take a position right now in an index, even though I would not take it in an index right now, I would rather take it in a commodities market. But the index levels look really juicier to me. The premiums are really good right now because the markets have been on the downside. So when the markets are on the downside, the juicier premiums are available on the put side. So you have to go long the market, meaning you go risk reverse the market. As a contrarian trader, that's what I do, and that's how we make money. We were really profitable last year. I will post my P&L soon, and then this year has started to be, I would say, maybe on the slower side. We haven't taken that many positions yet because of time situations and not really getting enough time to make videos. But recently, I took a position in oil, in the crude oil market, which is on my YouTube channel. Go check it out. The position is profitable right now. This is my paper trading account, but the actual position is in the real trading account. And I will post everything about that position whenever I take it off. It's probably up 25% right now. Okay, so what do I do here? I will go into the index, and this is my favorite index, by the way. Most liquid, most everything. This is the barometer of the US market, and therefore actually the barometer of the whole world, of the overall world market. So this is where I would take a position. Anyway, step by step, let's go through the trade. So what will I do here? My first focus is on the gray cycles here, the gray rows, because everything else is either a weekly or a Friday expiration or a daily expiration. I don't want that. I would stick to the monthly expiration cycles, which are gray. So the best one I can find, actually, that's not true about S&P 500 futures. I would sometimes take a position in these week 4 ones as well. These are pretty liquid too. So if you open this up, go down here and look at the volume and open interest. Obviously not much in this cycle, but let's take a look at something else. So let's go and find the end of month 47-day out cycle. What does it look like here? Yes, good, good open interest. Volume is a little bit on the low side, but open interest is good in thousands of strikes and contracts, which is pretty good. And this is how I would gauge volatility in these markets. I would look at this column and then I would look at this column. Obviously, it's a little bit slow on this side, but the next thing I would look at is, so my question is, do I want to take the position here in this cycle, or should I check something else? Let's check. We've checked the end of month. We've checked week. Let's check. 63 days is pretty, it's too far out for me right now. So let's check the 34 days out. How does that look? Pretty good, really good open interest. And this is where I'm thinking about taking a position, even though it's on the short side of DTEs, meaning I normally go for 40 to 45 days out, but here I'm only getting 34 days in a monthly cycle. So I'm thinking maybe I should take a position in this cycle. Let's see if we can manage the trade when it's, after 15 days, basically. So we're starting on 34 days. Let's see if we can manage. And then the weekend is coming up. So hopefully the markets will stay sideways, or maybe will go up a little bit on our direction. So let's take a position here. Like I said, this is a little bit on the low side, but because the volatility is up so much and the liquidity is tight here, I would rather take a position here than anywhere else. Because like I said, I cannot find any other expiration cycle which has good liquidity. I mean, I can check this 38 days out. Again, not much going on here. So I would not even look at this expiration cycle. Let's look at the week 1. How does that look? Not much. There aren't even that many strikes here. So waste of time to look at it here. Complete waste of time. So let's just stick to the 34 days. It's fine. We take a short-term trade this time, and then we'll think about managing it in 15 to 16 days. That's the whole idea. So let's go through the trade. Now, my second thing is, let me get my marker out again. Looking at this vicinity here, this is my locality. Delta column, and I'm going to go to 17 to 18 to 19. That's my go-to, those are my go-to strikes. So at 17, I'm getting 5,300. That's pretty good. I'm going to right-click on the bid side. Actually, it doesn't matter whether you click it on the bid side or the ask side. If you right-click and go sell and go vertical, because that's what you want. That's what I want to do. I'm selling a put spread. So I'm trying to sell a vertical here. Lower the number of contracts based on your risk appetite. Mine is always one contract. Even though this is my trading account, I treat this as if it's my real account. That's the whole idea. Because I want to take the teachings from here and the learnings from here and the knowledge from here onto my real trading account. So if I'm trading one contract, I'll do the exact same thing on my main live account. So treat this paper trading account as if you're trading live. So don't treat this as a joke. Yes, this is a learning platform and everything, but these prices are only 20 minutes delayed. Everything else is fine with this. Yes, the fills are a little bit off at times, but again, if you can master this here, you can master this anywhere else. Okay, so I'm getting 25 points out, which is totally fine, and I'm collecting $3. Now, when it says $3 here, it means you're collecting $150 because the number of notional conversion from this is basically half. So it's it's 1/50th of the strikes. So let's look at this. So this is the short put spread chart, which is long the market, and I need to change my break evens or my slices to break evens first. Set slices to break even to the expiration date 4/18, and then make sure you have the right expiration cycle here as well. So I'm highlighting this there. It's 4/18. It's pretty good. I like the number 8 in front of this, the probability of profit chart. I am going to make a max of $150 in this trade. Let's try and pull the trigger. I want to show the max loss. Now your max loss is $1,100. But again, just unlike equity trades, if your max loss was $1,000 or $1,100 and you're collecting $150, your margin requirement is basically your max loss minus the amount you collect. However, on the future side, you get better leverage. It's more cash efficient. It's more everything, buying power efficient and whatever you want to call it. But your buying power reduction, I will show you in a minute, like how efficient the futures markets are, futures options market, when you want to take the exact same exposure. So if you were going to take this exposure in the index options or SPY, which is the ticker that tracks this, it would have costed you 3 times more money, maybe even more. Here, I like the leverage that you get, the buying power efficiency that you get in the futures options market, and it's totally fine. Trust me, people are scared about these futures and futures options. I'm going to do a full video on how these futures work, and the options are basically a derivative of those futures. The underlying settlement is basically into that future. So they're all the same things. ES, SPX, and SPY, they're all the same things. So you don't need to worry about if you're whether you are correlated here or you're taking the right beta exposure, it's exactly the same thing. Anyway, let me show you the delta, the Greeks here. So this is our line. We're collecting plus 61 cents delta. Each point is 25 cents here, so 25 ticks. Be mindful of that. Theta, positive theta of 270. Let me get my marker out again. Positive theta of 270. Delta is 61 cents. You are short Vega because you're shorting vol here. That is the whole idea. You want to short the volatility side. These numbers do not really matter. However, I do make sure that this is 0 before we enter the trade. But it cannot be 0 because you pay commissions and everything else in the futures options market and in your stock options as well, but not as high commissions. So let's confirm and send this trade. Now let's look at everything here. Okay, so the focus is this line. Your max profit is $150 because you're collecting $3 here in the spread, right? So that converts into 150 real dollars. Your max loss is 1,100. So your buying power reduction should have been 1,100 minus 150, but that's not the case because you are in the futures options market. So what happens is your buying power reduction is only $326, and that's the efficiency of this market. Although you do pay $4.50 in commissions, one caveat here: if you are trying to do this trade on your real trading account, you will pay another extra. Maybe I'm getting this wrong, but maybe another extra $3 each way. So your total commissions are basically $15 to $16 in and out without any adjustments. If you do make adjustments, you will pay per adjustment. But even after all those costs and expenses, you are better off trading in these markets versus index options or equity options. Why? Because now you have 3 times more leverage here, meaning you can take the remaining amount that you are left with in your account and go to do something else. You can take 3 times as many positions as you would if you were trading a index SPX option or a equity SPY option. Got it? Okay, cool. So we agree with everything else. I'm just going to send this trade in. And I'm guessing this will fill right away because that's how it fills here on this platform on the paper trading account. And there you go. I can hear the ding. So it's already filled at 3. Perfect. And I also wanted to, so that trade is in. I also wanted to show you an Apple short call position that I closed out for about 7 to 8% return on this one trade. Now, what did I do there? So let's go through. This is everything in the last 30 days on this platform in my paper trading account. So look at the trading history. So look at this thing, okay? I took the trade on 3-4, short call, sold a call on Apple, expiring 17th of April at 260 strike. And I collected $1.59 on that trade. I also paid 65 cents to get in that trade. Anyway, long story short, today I closed that trade out for 16 cents, meaning I profited the difference between 159 and 16. And I'm really bad at mental math, so I'm not even going to try it. But yeah, it was about $140. You can see that by going into the P&L, the P&L Y2D, it's $152. But this one includes something I did here. I don't know what I did here. This was also profitable, but maybe I was doing another video and I took this trade, opened and closed the same day within a few hours. But this was my main one. I made a video out of this. I think it is on my YouTube channel. Just go check it out. If you want to know which one, DM me or message me and I'll let you know which one, because I don't even know which one it was. So what did we do here? Yes, this Apple trade was previously filled, like we can see. This one was filled today, so we made $140 odd in just 10 days. So if I have to do a net return on investment, I think it was coming up to like 7% when I did it this morning, because I paid down $2,100 to short that call without holding the stock. If I was holding the stock, there would have been no margin requirements, but I wasn't holding the stock, so I just shorted the call. So it asked me to put down $2,100 and I collected, let's say, 140 net. So that's 6.67%, right? Now you need to annualize this trade. So if you can do this trade maybe 3 or 4 times a year, your annualization factor is 4, and net you will make maybe 15 to 20% on just one ticker. That's the power of options trading. If you can do it well, you know what to do. This is how I would do it. Always trade short calls, even though if you don't have a long stock position. It doesn't matter. If you know what you're doing, you should short the call. If you think the market is really frothy on the top side, it's been really bullish, too far up, too quick, always short the call. That's what I do, but not in equities that much, but in the indices and wherever there is call skew on. So call skew is basically on in yes equities, and then yes commodities. Commodities is the big market for call skews. We'll talk about skews later, but yeah, this is the idea. Anyway, I did not mean to run the video this long, but ES position is on, and I'll keep everyone posted on this video. Thank you very much for watching.